All right, welcome back to the channel. Today we're going to be doing a quick look into Amazon, ticker symbol AMZN, and we got the 5-year chart up here, and we are sitting at about $127.96 currently. Recent highs were, well, over the last several years. The high was about 186.57. Low was about 67.20. The recent low at the beginning of 2023 was at around $81. So low 80s. And this is one that I started building a position out around low 100s and continue to add. And I think my average is about $95 right now, sitting about 11% of the individual stock portfolio, or about 3.5% of the total portfolio. So pretty happy with the position where I have it right now. Now over on this left-hand side here, you can see the 5-year growth rates. Revenue growth rate for the last 5 years has been at about 23%. Net income, EBIT, free cash flow with Amazon can kind of be wonky here and there, and that's why I'm gonna probably use the operating cash flow yield in order to do the evaluation. But so net income over the last 5 years looks like it's down about 2.14%, EBIT 9.3, and I'll have to look into the net income. That seems off, so that might be pulling an incorrect number. Free cash flow 21%, operating cash flow 20%. Look at the yields on the LTM basis, and let's just focus in on operating cash flow yield right now. And 5-year average for the operating cash flow yield has been about 4.14%, and currently we're seeing about 4.63%. So if we're just going off of that, it's around fair value right now, maybe a little bit discounted to historical averages. And margins over the last 5 years, we've got gross margins have increased about 3%. Operating margins have expanded a little bit. And then we get EBIT, net, and free cash flow that have been down. But as we will see, a lot of the temporary negativity for EBIT, free cash flow, net income were really due to like kind of one-time situations in 2020. I believe they took some investment losses for Rivian in that time because they hold the securities, so it turned into like a pretty large net income loss. With all that being said, that's usually why I've been going off of operating cash flow yield for Amazon, is because it's been one of the metrics that has seemed to remain pretty consistent, and it takes a lot of those variables out because they have been reinvesting heavily into CapEx expansion. So their free cash flow, their net income might not look really that good, or might have one-offs here and there throughout the last 10 years. And their operating cash flow, though, has remained pretty consistent. And when we look at the valuation from an operating cash flow standpoint, it seems to be the most stable. So that's what I'm going to go off of. Now, this is going to be a quick and dirty video, so just hang in there with me. We got stockanalysis.com up, and we're just looking at kind of forward estimates for revenue growth across various analysts. And we can kind of see that the average for the next 5 years is right around that 10 to 12% range. The low is pretty much flat. The high is in the, low 20s essentially. So we kind of have this now. I don't think the low is going to happen. I don't know what these analysts are thinking, but for them to remain totally flat, I don't even know what would have to happen for them to do that. Between the revenue segments that they have, so especially with like AWS growing at the clip that it has and the runway that it has, ads monetization, that's going to be growing at a nice clip. I don't know. The only thing I can see, like, as far as top line revenue growing, is if they were shifting away from retail and like pulled back the retail, because that's going to be most of the top line, and a low margin, and they focused on like, I don't know, a lot of their higher margin businesses, which in that case you get a top line regression, but then, or a top line slowdown, but then you would get a bottom line increase as those margins would increase from them focusing on those more profitable areas of the business. So with that being said, in the evaluation model here, I'm probably going to look at, scenarios between 20% growth on the more bullish scenario to about 8% top line growth, bottom line growth in the bearish scenario, or the scenario 1. Now let's go through some of the historical financials just to kind of check them out. Yeah, we can see from bottom line numbers or gross profit, operating income, EBIT, net income, operating cash flow, they've all been pretty consistent, growing. We had like this kind of probably pull forward a little bit in 2020 and then a regression. You can really see that with operating cash flow. But then we have a tick back up. So it looks like it's going to start resuming the normal trend line. They've been a growth beast. They've been doing really, really well over the last 10 years. And we'll see if they can keep that up. So not a dividend payer, obviously. So operating cash flow per share, you see, has had pretty decent growth. We're sitting at about $4.58 operating cash flow per share currently. And when we look at the bottom line yields over the last 10 years, you can kind of see the the EBIT and net yields are absolutely horrible. But those operating cash flow yields have been pretty consistent around that 3.5 to 5% area, really with probably 4% as the median. So we had a little bit of a drop down during, 2021. And that was most likely just due to the increase in market cap through that kind of boom cycle. And then we started dropping down. They've kind of seen normalization in their financials as far as revenue and operating cash flow. And we got into some pretty attractive, yields here from a historical basis for operating cash flow. In that sell down into 2021, or the beginning of 2023. And now we're kind of, we're at probably around like historical median. So it doesn't look like crazy, like a bargain or anything like that right now, but it's interesting as far as just fair value. Diluted shares outstanding, we can see that they have been diluting ever so slightly here and there. Operating margins and operating cash flow margins. Here we can kind of see the regression or the takeoff in operating margins, operating cash flow margins in 2020, and then the normalization kind of pullback, and now we're kind of normalizing back up to historical median. And I think we probably might see some margin expansion as well. So this could take off a little bit more, help those bottom line numbers and the operating cash flow margins. So let's go over to income statement. Hey, look, it's Amazon. It's been growing. Who would have thought? This is not going to be very deep. So yeah, EPS diluted, good EPS growth. And then we've seen kind of this pullback from those kind of one-time occurrences. Balance sheet, decent amount on hand, 64 billion on hand in cash and short-term investments. And then we got about 140 billion in long-term debt. So yeah, they are pretty well capitalized, balancing their debt and their cash on hand pretty well. Free cash flow statement. Let's see here. Dun. And we can see, hey, look at that CapEx. Who would have thought? Yeah, so obviously huge amount of CapEx going out as they grow. Operating cash flow, free cash flow. Yeah, free cash flow is pretty dang wonky. Stock-based compensation. Stock-based compensation has actually increased decently over the last, 2 years or so. Now I'm not sure if they're planning on cutting this back at all, but it is increasing a decent amount from their cash flows. A lot of it has been going back to debt repayment. So we see a lot of those outflows towards debt repayment and some common stock repurchases, but it's not making enough of a dent to actually decrease the share count. It's more just offsetting share-based compensation historically. Ratios and metrics, we can see that margin expansion over the last decade with a little bit of wonkiness here. It's going to be a new word, wonkiness. It's been wonky. Per share metrics, pretty decent, kind of valuation metrics. And man, I'm still finding things here and there that are messed up from FMP They recently made a change, and it kind of like shifted all my cells by like one cell. I've been slowly finding them and like updating them. But speaking of FMP, so I use Financial Modeling Prep for all of the API queries for my spreadsheets, and I do have a referral to Financial Modeling Prep in the description below. It takes about 20% off of the normal pricing. Additionally, if you want access to this valuation template, you can join the Stone Cold Investors Discord, and that link will be in the description below, and the valuation template is available to all supporters of the Discord. You can become a supporter of the Discord by writing 3 different valuation or company write-ups in the Stone Cold Investors Discord, or if you don't want to do any of that and you just want to lurk around, you can sign up for a $5 a month supporter tier, which will give you access to the channel that has the valuation template. All right, enterprise value versus market cap. You can see over the last 10 years, and yeah, pretty nice pullback here. Pretty nice pullback, and yeah, I don't know, nothing crazy discounted, but still looking pretty decent. So read metrics, we don't really need to look at this because it's not really a read. The only thing I could maybe look out is like, you know, interest expenses compared to operating cash flow, and operating cash flow compared to total debt. Obviously those are pretty dang good ratios. You know, you got operating cash flow to total debt. We've got 33% of operating cash flow to their total debt, so pretty dang good there. And let's see what else we got. Growth percentages. I think this is where most of my metrics are messed up, so I might yeah, we'll just visit that another time. So let's go over and go to the valuation template, and what I've got here. So this is gonna obviously vary drastically depending on your target rate of return. I'm looking at a 20% target rate of return. I would potentially go to like a 15%, but I don't know. Like, I'm pretty set on 20% for something that is in a sector that can be very, very volatile, and have pretty big sentiment shifts. You know what? I'll probably stick to a higher rate of return and hope for volatility to really bring that into my buy zone, especially when I've already got a decent position established around the $95 area. So, targeting 20%, we have bottom line growth, or actually, let's see, we have dilution between 0.66 to 1.15. We've got bottom line growth between best case scenario of 20.2% to worst case scenario of 8.28% yearly. And then we are going off of a operating cash flow metric. So for that, we've got operating cash flow between operating cash flow. Gosh, what am I thinking? Operating cash flow yield multiple. That's what I'm thinking. We've got that between 3% in the best case and 6% in the worst case. So, and remember, like, this is hard because, like, remember when Meta was going insane and selling off, they had an operating cash flow yield of, I want to say it was like 15 or 16% at the lows. I mean, obviously, if that happened, Amazon would absolutely get crushed. I don't think sentiment is going to get that bad around Amazon. Unless something drastically changes, I just don't see that happening. So I'm pretty confident or pretty comfortable with these numbers. And going from there, and kind of what I'm banking on is that they're going to be able to turn levers pretty quickly in order to bring their bottom line, like net income and EBIT and free cash flow, as they kind of have reach their maximum expansion, which is going to take a while. They're going to be reinvesting for a pretty long time, but I think they're going to be able to turn on that profitability pretty quickly. But if they can still grow at like a 20-25% clip, then yeah, reinvest. I don't care. Reinvest and get that growth. All right, so given these assumptions, we can see that we get a historical fair value of about 98 to 139 in the first 3 scenarios for the current price. So it looks like, I mean, we're currently right around probably fair value if we're just going off of operating cash flow yield multiple. And the 5-year targets for the scenario 1 would be about 137. That's a pretty bad case. And that'd be about 1.5% CAGR. Scenario 2 would be 181, which would be 7.27% CAGR. Scenario 3 would be 244, which would be a 13.82% CAGR. Scenario 4 would be 336, which would be a 21.37% CAGR. And scenario 5 would be 478, which would be about a 30% CAGR. So it's getting interesting. It's getting to levels that I would say are more in the probably fair value range for scenario 2 and 3, between that 116 and 139. But if you're shooting for a higher target CAGR over the 5-year period, you're going to have to get that at a discount. So the scenario 1 buy price for a 20% target CAGR is going to be about 54.09. Scenario 2 buy price for 20% CAGR is going to be 71. Scenario 3 95. Scenario 4 132. Scenario 5 187. Now, if we change that to, say, a 15% target CAGR, those move to scenario 1 being 69, scenario 2 being 91, scenario 3 being 123, scenario 4 being 170, and scenario 5 being 241. So that is what I got for you guys today. Hope you are having a great week, and we will catch you in the next one. As always, I am not a financial advisor, and none of this is financial advice. This is just my musings on another company and another potential valuation. So I hope you enjoyed it. If you did, please hit the like and subscribe button, and we'll see you in the next one.